In this video, I'm going to analyse Barclays Stock by giving my views on the business and whether I would buy Barclays Stock right now. As usual, don't forget to leave your suggestion in the comment section down below so that you can select the next FTSE 100 stock that I will analyse. And also don't forget that coming at the end of the year, I will be covering US listed stocks. So don't forget to drop one of these to support the series. Today, I would like to make a different disclaimer, and firstly, I'd like to apologise for being late to the upload, and I would like to respond to some criticism at the same time. Recently, as the channel has been growing in size, I've obviously had an influx of newer people, and obviously, whilst I love criticism, I think it's incredibly useful. I think at this point it's important to address what the purpose of this series is. And a lot of people seem to think that they only need to watch a video and then that's it, their investment knowledge is fine. And whilst that may work for some people, the intended effect of this is to take a brief fundamental analysis of a stock that would be short and simple, but also is the basis of your research. So that not only do you do your own research from this video, but maybe it sparks your interest in a stock that you hadn't heard of before. And so whilst yes, I always appreciate your honesty and criticism, please bear that in mind that the process of this series is not directly to be an all-in-one video that tells you everything you need to know. As in my honest opinion, I feel that when people are actively doing the research on their own accord, that it will be more useful to them and they will learn more from it. Anyway, thank you all for the support and I will now get into the video. Barclays provides various financial products and services internationally. They offer retail banking, credit cards, wholesale banking, which is effectively the opposite of retail banking but more or less lending to governments or perhaps other banks, for example. They have investment banking, wealth management and also investment management services. They have a market capitalisation of £18 billion, 132,000 employees and are listed on the FTSE 100. Barclays are the 19th largest bank in the world by assets under management. When I first like to start an analysis, I like to look at how the market values a stock. In Barclays' particular case, we can see that according to their price to earnings ratio, it is trading at a lower multiple than the market. When we look further into their price to book ratio, which is comparing their net assets to their market capitalization, we can also see that they are trading not only lower than the industry, but also the market as well. Whilst to some this may say that, oh wow, Barclays is undervalued, I simply believe this is not the case. And in fact, perhaps that this indicates to me that there's lower sentiment, therefore perhaps it's going to be a more volatile stock. Investors are not as confident on the stock, and in my personal opinion, it's more difficult to gain multiples in price to earnings growth simply because it's starting at a lower valuation and it will take a huge nudge to boost it. Since a majority of the investors are by institutions, which is 84.2%, I suspect that these investors very much believe that this stock will underperform the market, otherwise they would be accruing or accumulating more stocks and have less available to the general public. Although I don't invest purely on valuations, that may work for some but not for me. I like to look at the growth potential of a business. I'm not going to look at the management's effectiveness, which would be looking at things like return on equity, return on assets, or return on capital employed, simply because this is a financial institution and I suspect that their equity metrics may be a little bit mushed up. However, what we can look at is their earnings growth. In the last 5 years, they've managed to grow their earnings by an annual compound growth rate of 37.5%, which may look brilliant. To an investor, you may think, yes, excellent earnings growth. If we zoom out a bit into a longer 10-year period, we can see in fact that this has not been very stable and is very cyclical. But not only this, in the last 10 years, they've had a revenue decline of 51%. I do believe this is understandable. This is because ever since 2007, the great financial crisis, regulations and changes have been made to these banks that mean that they have to go under stricter measures, meaning they cannot lend out as much, and certainly due to a low interest rate environment that they are very much less profitable. In the long term, perhaps this could change, however, and that's what you would be investing in if you're buying this stock. As you already know, at the start of 2020, during the peak of the pandemic, at least so far, the banks were told by their regulators, such as the Bank in England and the Central European Bank, that they should suspend their dividends so that they can increase their cash position, so that they can therefore lend out more to the population, which stimulates the economy further. So it would be very unlikely that if the pandemic continues and it gets worse, for instance, that paying a dividend may not be an option for these banks. I, in my own opinion, feel that in the next financial year that this will recover, but that's because I feel that this pandemic will perhaps not disappear, but I believe that we will just learn to move on, and the ones that are vulnerable will shield, but the ones that aren't will likely just carry on and get on with their lives. Prior to this, however, they did have a biannual dividend that would be paying in September and April each year, yielding roughly between 2 to 5% in the last 5 years. Whilst in the last 20 years they managed to pay a dividend every single year, it's not been a clear-cut growth path or even much growth at all. Prior to the financial crisis, they had excellent growth rates, and you could see how much of an attractive investment banks may have been. However, since then, it's not been so good. Many regular cuts, low growth, it's not really a great dividend environment at the moment. Regardless, what they can be is a reliable income investment, but when you look at their share price history over these time periods, they've not really generated growth returns, and in fact you would have lost. So not only are you trading dividend income for capital depreciation, but you're also losing out on both. I suspect that should the pandemic start to ease, our global economy begins to recover and interest rates start to rise, then these banks will once more become more profitable, in particular Barclays. But at the moment it seems very unlikely for the short to medium term. And I feel that, as I said, Barclays should be resuming their dividend in the next financial year, as they are proving that they are still profitable in times of uncertainty and can also manage their extreme lending. And if you're interested in buying Barclays, sign up to Trading 212 using my link in the description down below to get a free share worth up to £100. At a glance at the quality of the balance sheet, it would be considered closer to poor than good. This is because their short-term assets do not outweigh their short-term liabilities, but do outweigh their long-term liabilities. This is a financial institution, so things are different to say the least. And when we look at a typical debt to equity ratio, you would see that their lending is like tenfold. But in reality, this is typical. So what I like to look at for a financial institution is where their cash position relates to their debt, or more or less a cash to debt ratio, in which we can see that there is a total debt of £672 billion and a total cash position of £634 billion. I feel that this is an adequate enough distance, despite being slightly under, that it is manageable and that it's not too high of a debt load. Typically, many retail investors would believe this stock is undervalued. After all, it is a well-known name that you would likely seem to understand, although I feel this is not the case, and this could sometimes lead to value traps. I don't think Barclays is a value trap, but if you don't understand your investments, you may be selling out as they lose capital returns, and then it would be a short-term value trap for some. I suspect that this stock is a lot more complex than meets the eye. And after all, you are going to have to do your own research on the company. And you may not have known in particular, whilst believing that hearing the news articles that Barclays are in fact profitable, this isn't actually the case when we look at their UK sector, which their UK income has actually decreased by 12% year on year. It really goes to show how globally diverse Barclays is as an institution. I suspect a combination of the pandemic crisis, low interest rates, and taking on many bad loans to stimulate the economy has very much put them under a very challenging environment. I feel that over the next 5 to 10 years that this environment should change, but I wouldn't invest without a long-term mindset towards this stock. I feel that it's more or less a value recovery play in which you're betting on the global economy to recover over the next few years. But at that point, you may just be better off with a global or world fund. And I feel that Barclays would be a bet on this economy recovering, and that once the stimulus starts to wind down, interest rates start to rise, and this would really start to see its shareholder returns. If you'd have owned Barclays in the last 5 years, you would have gotten returns of minus 50% on your capital with dividends reinvested, which not only underperforms the market, but also the industry. I feel that for a person looking for a bit of extra risk, they have a staple portfolio, perhaps many defensive stocks. They're looking for a stock that would be more risky in terms of volatility, capital movements, but not necessarily risky in terms of financial stability. Then perhaps Barclays is a nice stock to have in your portfolio with a smaller allocation that would be your hedge towards the general economy recovering. Although I suspect you would very much have to have a longer term mindset on this stock. As I said before, they could be continuously decreasing for the next 5 or even 10 years, so it's best to be steadily, consistently averaging sums into this position rather than buying a lump sum now and then hearing the gloom and doom that the economy is getting worse. My issue with Barclays stock is not an issue specific to the company, but rather the industry, and that's they are too much tied to politics and the general economy. This means in times of uncertainty, these stocks are going to lose shareholder returns. And in these times of uncertainty, I would like stocks that are perhaps the dark horses of this race, and that rather than decreasing in value, in fact, they are companies that are more resilient, and after a few months, that in fact investors realize, hang on, this stock here is so much more valuable and can benefit in this time of uncertainty, perhaps a recession, and therefore the value is going to increase as more people want to buy it. And therefore, I just don't feel that Barclays is a stock for me. I will be looking at this stock over the next few years with hopes that as our general economy recovers, it might be a more sustainable investment for me. And that may mean missing out on a lot of the shareholder returns, but I don't want to take that extra risk. If you're interested in the stock analysis of the parent company of Paddy Power, Betfair and the Stars Group called Flutter Entertainment, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great weekend.